From the morning reading, supply and demand battle to a spinning top on Wednesday. CSX gains after hours. 6 of 10 sectors moved higher on Wednesday. XLRE, XLU, and XLP were the strongest sectors, while XLV was again the weakest sector. Oil futures slipped 30 cents to close at 50.86. Breadth strengthened compared to the prior session as advancers led 15.55 to 14.45 on the New York Stock Exchange, and decliners led 14.49 to 13.27 on the NASDAQ. On the S&P 500 snapshot, Fed Wednesday, not so much. Today was a light day on economic news aside from the JOLTS report, so the popular financial press was focused with bated breath on monetary policy, namely possible clues in the 2 p.m. release of the minutes of the September FOMC meeting. The S&P 500 showed a bit of indecision at the open, which included its 0.19% negative intraday low. The index then zigzagged in a narrow trading range for about 90 minutes to advance of the potential FOMC drama. When you check the market's subdued response to the Fed minutes in the chart, a brief gyration to the 0.40% intraday high, then the index trailed off to its fractional closing gain of 0.11%. As for the Fed drama, the day's high-low range was at the 28th percentile of the 197 market days thus far in 2016. The yield on the 10-year note closed at 1.79%, up 2 basis points from the prior day's close. This is the highest closing yield since 1.81% close on June the 2nd and well off the 1.37% lows on July 5th and 8th. Breadth is weakening. The price action of stocks not necessarily being accurately reflected in the major indexes. Several breadth indicators are below the thresholds that usually indicate downtrends, and an abnormal percentage of stocks are currently trading below their medium-term trends. Given how close the major indices are trading to their 52-week highs, the past month has seen the largest number of similar divergences since the year 2000. ETF traders have shown a preference for junk over safety. In the past 3 weeks, the HYG fund has added nearly 15% to its asset base. At the same time, the most popular treasury fund, TLT, has lost nearly 20% of its assets. When these traders have favored high-yield bonds over treasuries to a large degree in the past, HYG has tended to underperform the TLT. Apple is the 7th most loved stock in the S&P 1500. It's rare to see such a large cap stock near the top or bottom of the list, and indeed Tuesday's optimism index of an 86 is tied for the highest ever in the 5 years of the history that is available. The stock has tended to pause after such high readings or give back further short-term gains during the subsequent pullback. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:26 a.m. Mountain Time, and I'm recording this in preparation for the market day of October the 13th, 2016. Remember that on YouTube, you can have a free subscription to the channel and be alerted to new content being published. Give the video a few minutes after being published for the video to be available in high def. Click on the setting button to choose the high def playback level. In this same area, you can also control the speed of the playback. I routinely find that I can fully understand videos at about 1.5 times the recorded speed. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and get into the morning report. At the time of this cut, we did have weakness, pretty significant weakness, especially given where we are on the charts. The S&P futures are down over 0.5%. The Russell futures are down about 0.2%. The NASDAQ futures are down well over 0.5%, as are the Dow futures down over 0.5%. Crude oil's up just over scratch. Euro's up about 0.25%. Bonds are up about 0.4%, and gold is up about 0.5%. In overseas action, China's up just over scratch. Hong Kong down about 1.6%. Japan down about 0.4%. Germany down about a little over 1%. And the United Kingdom down a little less than 1%. In terms of macroeconomic reports for today, in the United States, of note, you had the weekly unemployment claims, import prices, nat gas storage, crude oil inventories, the 30-year bond auction to round everything out. So a pretty good schedule for today. And looking forward to tomorrow, again, for the U.S., you have core retail sales, PPI, FOMC member Rosengreen speaking, and then the University of Michigan consumer sentiment. Also, note that during the trading day, you will have Fed Chair Yellen speaking as well. In terms of current volatility conditions, obviously, we've had a bit of an increase in the last couple sessions. Short-term VIX at a 13.16, still relatively low. Skew also still relatively low and benign at less than 125. IV percentiles also still relatively low. They're up above levels that they've been in recent weeks, but still, notice they're all still in red. They're all still in the lower third of their range. IV percentile for the S&P is a 30, for the Russell 29, the NASDAQ a 26, and the Dow a 29. No standard deviation moves were put in yesterday. Indeed, I think one of the morning authors mentioned that we had a spinning top. So actually, it was a relatively balanced day. And in fact, let's go ahead and go to the charts. So here's our current action on the SNP chart. And you notice this kind of medium-sized body, wicks on both ends, a bit of a spinning top. I prefer, frankly, a bit more of a wick off the bottom. But one of the things to consider here, in the context of where we are, we're still inside the cloud, but you know, we had this break day here. This was significant. That's why we went to hedge risk level 1 on this day, and certainly this was a follow through on that action. And then after the market closed, we seemed to pick up the speed on that drop, and now we're currently down here near the bottoms of this action from 9.9 through about 9.15. So we're starting to kind of play with the lower levels of all the recent swing lows. And if we were to break this, when it's also a big round number, if we were to break this 2100, and then probably shortly after such a break, we would also break below the cloud into what would be called a cloud breakout. That would be very, very significant, and we would probably go at that point to hedge risk level 2. So if you're asking yourself, okay, well, we're at level 1 now, what does it take to get to level 2? It probably is a closed and breakdown below 2100. So that could be done, and that's only literally about 15 points away. That could be done in a day. That could be done today if price action were to deteriorate. Not saying that's going to happen today by any means. We'll have to wait and see, especially when the cash market opens, what all the participants in the market do. We could easily reverse off these areas and get right back up into where we've been and enter into more of the sideways consolidation pattern. But just kind of giving you a heads up that if this were to further deteriorate, this is even more important by the fact that, remember, this is the area of former resistance now turned support. And this had an enormous amount. If we were to look at market profile, you'd see there was been a huge amount of volume that was traded at this level. So this is in the past had been where we've been hitting our head. If we were to fall through that area, that would be measured by the market as being extremely significant and would probably bring in much lower levels as a result. So we'll need to very carefully watch this during the trading action today and see just what is to come of this. But we definitely have seen some deterioration in their market condition. You should be definitely using your action steps for hedge risk level 1 to review all of your positions. You see the same situations happening in the Dow. You have the initial break of the diagonal support. Now you have the follow through, getting lower in the cloud and coming close to this breakdown up below the cloud, which in the Dow futures would be around 17,800. And the NASDAQ, of course, we've been much more bullish, but we're about to break down, not just through the diagonal support, that's already happened, but we're also getting ready to break back down into the cloud, which would be quite a change in market tone for the NASDAQ, given how strong it's been in a relative sense to the other markets. It was just a few days ago that we set a new intraday 52-week high, and that certainly has been followed by very quick selling all the way around. And the same thing over here on the Russell futures. You see it's also coming into the cloud and coming in to challenge these former areas of swing lows. And if we break through that, we likely also break below the cloud on the Russell. So as these things kind of come together, we're likely to see some confluence and energy being derived one off the other, and then breaking them all down, or finding that they all find support, and we just kind of back away from the edge of the cliff, as it were, if the bulls still have that much energy left. Now you see, in terms of the where does money go when it's fearful? Well, it doesn't seem to be going to gold right now. It also doesn't seem to be going to bonds right now. And in fact, one of the morning authors suggested that we might be going to high yield bonds, not the long bond as in TLT. And it just had a new 52-week high just a couple sessions ago. So it is a little different market breakdown this time, in that we don't see some of the traditional places that money goes seemingly to have any action. Let's go ahead and take a look at, let's see, that was the bonds, the gold. Oh, crude oil. I know there's one that I was missing. Crude oil, of course, is pulled back from touching its 52-week high area. Now we have a double top area. So we're going to be in kind of an interesting area here, where we're between this former resistance, now turned support, should be, and this overhead resistance, a relatively small area here of you know, a little over $1 on the crude oil futures. So we'll see where crude oil resolves. The fact that this is going up, and some people have suggested that crude oil could go to $60. If crude oil were to start going to $60, that would have some negative dampening effects on the big economy in terms of the cost of energy. So it's something to consider. And then, of course, we are having a spike in volatility. And while we haven't met the definition within the session, with this day right here was about 2.5 points increase. Normally we look for a 3-point increase in volatility on a close-to-close basis. But we're going to have a bit of a gap here today, it would seem like. And currently we're up over 17. And you can see in the past, when you start accelerating volatility, it can spike up hard and fast. That's the nature of that side of the equation. Okay, let's see. Let's go to the daily report. We have had some important changes on the daily report compared to yesterday. And again, we always focus on the change and the rate of change. Now, what did not change from yesterday, we're still market phase 5, the break of diagonal support. And in the 3 market timing signals, the first one did not change. We just had a change here in the IBD, Investors Business Daily signal, went to uptrend under pressure, so that was a deterioration. We've now had, with yesterday's action, the GMI index has gone to a sell signal. And we mentioned yesterday that it was borderline and close to going to a sell signal, and sure enough, with yesterday's action, it did deteriorate to the sell signal. The stock chart's decision point, the third market timing signal system, also deteriorated, and then we got a new bearish signal on the Dow. So on the Dow, you now have short-term neutral to bearish, intermediate-term neutral to bearish, long-term mixed. On the S&P, on the short term, you have neutral to bearish on both versions of the S&P, and then mixed in the upper time frames. NASDAQ's mixed on 2 of the 3 time frames. So this is not real positive. It's hard to pull a lot of bullishness out of this. And in fact, you'd have to say that if you look for a consensus across these signals, that this is currently postured to the negative side slightly, not terribly, but slightly. And, but that's a change. We've been slightly bullish in the consensus of these signals, and we have flipped over to slightly bearish on the signals. So something to kind of keep in mind. Position sizing opinions at 50% on the first model, the second model 75%. If it goes up over 18, that will then drop to a 50% as well. So keep that in mind. Intermediate term market posture has turned to strong bear signal, and that's reinforced with the weak bear sentiment line. You see the S&P is below a 50, so that gives it the strong bear. The Dow was already below a 50, and then the Russell also coming in with weak bear, and then new change here. The NASDAQ has gone from a severely strong bull to now a weak bear. So all 4 indices are now pointed down. In terms of the hedge warning status, as I mentioned earlier, we had gone to level 1 a couple sessions ago now, and that is our caution light. So we should be absolutely very sensitive and aware that conditions could start to deteriorate further, and once we go to level 1, we often see level 2 and 3 in very quick order if things continue to build. In terms of option income strategies, or under our strategy opinion section here, the VIX is still in the acceptable window, but we're starting to challenge the upper threshold of that window. So if you do choose to initiate a new position as a novice trader, you need to be cognizant of that and perhaps want to reduce your position size. The other 2 strategies, covered calls and put selling, not acceptable to initiate new positions for novice traders. Aggressive traders may take advantage of the movement and additional premiums that are available in these higher volatility conditions, but they know that they're going to need to be able to accept the adjustments and the and are able to make the moves and handle the adjustments should situation further deteriorate. So just kind of keep that in mind. In terms of the overall warnings area, I will say actually these first 2 did ebb off. This should be in the OK status. This one should also be in the OK status. The volatility ratio warning did fire 3 sessions ago, and certainly has been, it's a, in quotes, a successful firing, and we've seen the volatility tick up, and volatility with respect to the VIX, now heading towards 18. Distribution day count very high, with the S&P now at an 8, the NASDAQ at a 5. You see under the trend base, you now have strong bear, the market phase 5, and the New York Stock Exchange with a very skewed count towards the new lows. Even though yesterday was a spinning top, it was certainly more balanced to the bearish side than it was to the bullish side. While it's not over 300, it certainly is quite skewed. In terms of the intermarket risk aversion indicators, we have 3 still holding as risk on, but 2 are currently risk on but clearly rolling over. We'll see if they indeed cross and if we start to see action start to build on the others. Not yet signaling a big down move by any measure, but they have seen some evidence of deterioration from that group of indicators. Sentiment is all relatively neutral for stocks, though bonds very, very extreme there. And the overall fear and greed index, you see it's a 45, relatively neutral there. On the sector specific, we did have some kind of interesting action yesterday, and while the overall day was negative, you did have some of the more defensive sectors performing better. Real estate, utilities, telecom, consumer staples, all 1 through 4 in terms of their performance. So the high beta kind of areas were, and generally the ones that were giving it up or just eking out small positive days, and you see just barely, more than half of the holdings that were in the positive. And still significant amount of red here in the market postures across the 3 time frames. Overall, energy and financials are the 2 sectors that are most consistently holding up, though they had a weak day yesterday. And then down here, also, you see, if you look at the 5-day, 1 month, and 3 month, really is still a significant amount of red. These conditions could continue to deteriorate potentially. So when we roll all this up, we've had a clear deterioration of conditions in the last couple of trading sessions. The question is do the bulls come in, and is this typical in if we're truly in a bull market? The bulls should come in when challenged at these key support levels, and we should then back away from the edge of the cliff. If we bounce over the cliff and continue this breakdown, then we're likely looking at something of a larger pullback into perhaps correction territory. If we indeed break this cloud, it will call into question the lows from June could very much come into question, and then that would then bring us down potentially into the 1984 area in a pretty quick manner. It could come that way. So that is some 125 points roughly that we could give up on the S&P should these current nearby support levels fail. So just think about that. You might go from just a few weeks ago, 2191, down to potentially about 1982, and that could be in the cards if we were not to see the bulls come in and support these key support levels. So be prepared for that potential. It's not yet a high probability by any means, but it is a potential that's on the chart. Okay, we're a little over 20 minutes, so let's go ahead and wrap this thing up today. And of course, as I go through these slides, you see something of interest, just hit the pause button, and you can get more information, and there's additional hyperlinks and so forth. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll see you back here for the next Falcon Global Market Preview video session for tomorrow. In the meantime, manage that risk, and you should see everything else fall into place. Good trading.